Before we get started, I want to know, are you trading metals actively or holding them long term? Drop trader or investor in the comments and tell me your focus. If metals are your primary strategy, say so. Today we're unpacking something unusual in the silver market. Numbers that don't just tell a price story, but hint at a fundamental shift between physical supply and paper pricing. This matters for everyone from industrial users to serious investors. Let's begin with the core data point. Physical silver prices in Shanghai are holding in a high range, while the US paper futures price on COMEX is notably lower. Recent analysis shows Shanghai prices commanding a significant premium over Western benchmark pricing, a pattern that typically signals tightening physical markets. Under standard conditions, arbitrage, like buying cheap and selling expensive, would smooth this spread. But that arbitrage isn't happening efficiently right now, suggesting real stress between physical demand and paper supply mechanisms. Now, let's put some real figures on this. Recent reports from COMEX vault data showed significant registered silver withdrawals in a single reporting period, approaching millions of ounces leaving major vaults. When physical metal leaves inventories faster than it is deposited, that reduces the pool available to satisfy futures deliveries. Industry analysis confirms that physical drawdowns can change market dynamics when the paper market cannot easily replace metal. Chart patterns also support this narrative. On short-term price charts, down days are often accompanied by lighter trading volume, while upward moves show heavier volume, a sign of strong buying interest that isn't being overwhelmed by selling pressure. When traditional indicators like RSI don't hit oversold conditions despite downward price attempts, it suggests the selling may be more tactical than fundamental, a signal that the physical market is asserting influence over the paper market pricing. This disconnect makes more sense when you look at the broader demand picture. According to the Silver Institute, industrial demand reached a record 680.5 million ounces in 2024, making up the largest share of global silver usage. This isn't an abstract trend. Silver is a critical component in solar panels, electronics, EVs, and infrastructure, areas of rapid industrial expansion. Even US government data shows silver is widely used across industrial and electrical applications domestically. On the supply side, global mining output has not kept pace with rising demand. The Silver Institute's data shows that total silver supply growth has been modest, and recycling, while at a multi-year high, only supplements a small portion of total needs. Meanwhile, demand has outpaced supply for several years, with structural deficits accumulating, a trend confirmed by multiple industry surveys. So what does this mean for paper markets like COMEX? When physical demand tightens and inventories shrink, the risk emerges that paper contracts can become detached from the actual metal available. Reports have noted that the drain on COMEX inventories can increase the risk premium for holding paper positions, potentially weakening the price discovery role of futures pricing. This dynamic doesn't just affect traders. It can influence how major financial institutions hedge, allocate capital, and manage risk in commodities markets. Let's look at three possible trajectories. Premium compression. If Shanghai premiums normalize and demand stabilizes, the spread could tighten. Persistent divergence. Continued withdrawals in physical demand could keep premiums elevated. Global tightening. If other major markets also see inventory drawdowns, this divergence could become global rather than regional. Each scenario carries different implications for producers, investors, and industrial users. Here's what you should take away. Silver industrial demand is at all-time highs, driven by real applications, not just speculation. Physical supply is limited, and inventories are tightening. Physical prices are diverging from paper prices, a sign that fundamentals are asserting influence. These trends matter whether you're a long-term investor or a short-term trader. To wrap up, the silver market today shows a telling divergence between physical realities and paper pricing. This isn't hype, it's supported by industrial data and confirmed by recent market behavior. Make decisions based on verified data. Monitor physical premiums, COMEX inventory reports, and global demand trends. Dive into the Silver Institute and USGS reports yourself. That's where the clearest picture of supply and demand lives. Research thoroughly, understand the fundamentals, and invest with clarity, not emotion.